All right, I think we'll get started right now. I appreciate everyone's time this morning, and we think this is a very timely subject that we're approaching. It's April 9th, 11 a.m. Appreciate your attendance. I'm very pleased to have Molly McAvoy, who's a partner with Armstrong, Bristow, Farley, and Schwarzschild. Molly's practice focuses on estate and tax planning for individuals and families. She specializes in the administration of estates and trusts as an executor and trustee and beneficiaries. And also, we have Tim Call, President and CIO of Capital Management Corp. Tim has been President and Chief Investment Officer since 2006, so he's seen a few cycles in his day. So we're very pleased to have both here. And with that, we will have a brief slide deck here that we go through, and then after that, open it up to Q&A. And for those who haven't done it before, there's a little questions box on your panel there down near the bottom that you can type in a question, and we will address it after the presentation. With that, I will pass it on to Tim Call to start us off here. Tim?
Yes, thanks for joining us, and hope everybody is well, and luckily everybody's well at Capital Management. This first slide shows the response of the government, the federal government, to the virus and crisis and closure of part of America. And what we see here on the left is the size of the law that was enacted, the stimulus spending of almost $2.3 trillion. So the federal government's going to get that out pretty fast. This is larger than the two stimulus packages that were passed during the financial crisis. And it obviously at a faster speed as well. So that is good news. The third entry on the left, the 510 billion, has something tucked in there, 454 billion for the Federal Reserve. And the Federal Reserve can use that backstop, which they're doing this week, to guarantee parts of loans, enabling banks and the Federal Reserve itself to expand their balance sheets at a factor of 10. So basically, it's $4.5 trillion worth of power there that the Federal Reserve, through banks or directly itself, can increase its balance sheet and send out these loans. And word is trickling through the market of different programs the Federal Reserve is doing that with that right now. This is odd that they're buying risk assets. Usually they only buy risk-free assets, which by their definition is government-backed securities, U.S. Treasuries and mortgage-backed securities. So the Federal Reserve, in 1 week last month, bought 625 billion of those. So that's separate from this program. And that's more than Ben Bernanke purchased during all of quantitative easing one. And then Chairman Powell says the ability to buy U.S. Treasuries and mortgage-backed securities is unlimited. So they are moving very aggressively and very fast, and that's good for the economy. So if we are able to reopen the economy this summer, this will be extremely stimulative, and it's going into the market right now. On the far right-hand side of the page, we see the budget deficit, and so that will go up this year with all this stimulus. The whole interest rate yield curve for the U.S. Treasuries was under 1% at one point, which is a record. It's never happened before. Now the 30-year Treasury is a little bit above 1%, but we don't think interest rates will necessarily move up a great deal, even though all this debt will be issued short term, and that's because the Federal Reserve is there buying the debt. But as we go out a couple of years, the Federal Reserve will stop expanding its balance sheet, might start shrinking its balance sheet and you'll still have all this debt outstanding, and the government will have to roll forward its debt plus issue another trillion every year for the regular budget deficit. And so when we look out a few years, we see interest rates rising because of all this debt being financed, and the biggest buyer, the Federal Reserve, no longer buying that debt in a couple of years. So we are worried about that long term, but short term and intermediate term, these are very stimulus factors taking place. So both the federal government and the Federal Reserve moving on a combined basis a little bit less than $10 trillion into the economy. And when we go to the next page, we'll see why. And that's almost 20% of the economy has been put on hold. So travel and entertainment and specialty retail, all these areas add up to roughly 19 or 20% of the U.S. economy, or gross domestic product, and that's shown in the upper left. And this area of the economy affects around 20% of Americans who have jobs. And so this is resulting in massive layoffs. Not every segment will have as many layoffs as others. So when it comes to transportation, local delivery, moving e-commerce, we're seeing job gains in those areas. But most of the rest are seeing jobs being cut. Luckily, these are lower paying jobs than the average job in America. So it's 20% of payroll jobs, but less than 20% of payroll in dollars. On the right-hand side of this page, you see this represents 7% of the operating earnings of all the companies in the S&P 500. So all of a sudden, 7% of the earnings of the S&P 500 will go to a negative number in the upcoming quarters. When the economy gets reopened, which hopefully that will, we'll see some early indications of approvals from the FDA, Federal Drug, and we'll see a downtick in cases because of the quarantine. So America will reopen, but that doesn't automatically mean everybody's going to go out to a restaurant for lunch every day. A lot of people still will be leery of going out. A lot of people who are remote working might decide they enjoy working remote. And then the restaurants and facilities themselves, planes, might have some regulations saying the tables or the chairs have to be a certain distance apart from each other. So the amount of travel that takes place, the amount of entertainment and restaurant and bar income will be rather slow to come back, but it will come back. So compared to March and April, where some of these companies have very little revenue, they'll have more revenue in the summer. Thus, the recession we're in right now will start to turn into a recovery, albeit from low levels. And then luckily, the rest of the U.S. economy isn't as affected as these segments. In general, we do see that economic recovery coming soon, and we see all this stimulus coming out of the federal government and the Federal Reserve, and that indicates a rebound for the stock market. Usually the stock market rebounds during or starts to rebound during a recession, and usually job losses continue to tick up, unemployment continues to tick up as the stock market starts to recover. Basically, the stock market is pricing in an economic recovery in advance. And so that's typical, and this is, we believe, going to be a very short recession. So it makes sense that the stock market has found a bottom or is testing a bottom and should have a recovery soon. And we'll see more about that a little bit later. But with the stimulus law that was passed. There were some other changes that affect estates and taxes. And there's some strategies from both a tax standpoint and an investment standpoint that could be advantageous because of this law. And so, Molly, if you could review some of those changes, that would be helpful.
Sure. And thanks to all of you for listening in this morning and participating. And like Tim, I hope that everyone is well and at home. As Tim was saying, there have been a lot of stimulus measures taken over the last few weeks. They seem to be rapidly changing. One of which is the CARES Act that was passed at the end of March. I believe it was March 27th that the CARES Act was passed. And among the tax provisions in the CARES Act, Congress has suspended the 2020 required minimum distributions for retirement account participants. Now, why did they do this? Well, required minimum distributions are calculated based on the value of a retirement account at the beginning of the year. So if we can bring ourselves to remember back to January 1 of 2020, which, this is a leap year, so we did have 29 days in February, and I think we had probably 300 days in March. But if we can go back that far, the market was much higher. So 2020 required distributions for many participants were very high. And in an effort to help folks, since the market has declined, Congress has said you don't have to take the 2020 required minimum distributions. It applies to IRAs, 401ks, Roth 401ks, and inherited accounts. It applies to any RMD that for 2020, including account owners who turned 70 and a half in 2019, who had to take their first distribution in 2020. So if a participant who turned 70 and a half in 2019, that person was given until April 15th of 2020 to take their first distribution. If they have not taken their 2019 distribution in the first 4.5 months of 2020, it appears that distribution is also suspended. So for those lucky folks, they get to suspend their 2019 and 2020 distribution. Note that I was using the age 70 and a half, which for those of you who followed the Secure Act, which was passed at the end of 2019, that has increased the age for required distributions to 72. So this, so this is effective for participants based on the pre-Secure Act rules. The other unique planning opportunity with this suspended distribution, if you have taken your distribution already in 2020, any distribution that's been taken within the last 60 days may be eligible for a rollover contribution to a new or an additional IRA, which means that if you have taken the distribution, you're sort of given a freebie to put it back, if you will. There are some requirements that you have to meet, so you do have to be cautious with that, but it's certainly worth pursuing if you have taken your distribution within the last 60 days. Note that if you are the beneficiary of an inherited IRA, this is not applicable to two inherited IRAs, and that's because the inherited IRAs are not typically allowed to roll over a distribution. Another part of the CARES Act as it relates to required distributions are distributions for COVID-related issues. If you are an individual who has been diagnosed with COVID, has a spouse who has been diagnosed with COVID, or is having some other financial hardship, whether that's a loss of a job or similar, increased expenses related to that, you may be eligible to withdraw $100,000 from your retirement plan this year. Typically, and you don't have to reach age 59 and a half, and you are not subject to the 10% penalty. Um, so that's really trying to help folks out, understanding the economic crisis that we're in right now with um, people's jobs being furloughed and things like that. This is a way for you to access funds that you've put away without any penalty. You still will be required to report the income from that withdrawal, but you are allowed to spread it out over 3 years. So it spreads out the tax impact of that, which is very helpful because that is ordinary income to someone who withdraws those funds. And again, if you don't use all of those funds, you may be eligible to recontribute the withdrawn amount without consideration of the typical limits. So Congress is really trying to come up with a lot of different alternatives to help stimulate the economy. And hopefully this one will be very helpful to folks, allowing them to leave money in retirement plans and benefit from the growth that that Tim projects that we'll be seeing over the next year or so. Other things unrelated to the CARES Act, Brad, if you want to flip the slide, thanks. The IRS has also extended filing and payment due dates. I do a lot of income tax work, mostly fiduciary, but we were scrambling trying to get tax information, and as you can imagine, folks were not necessarily focused on their taxes. That said, really, until people have been stuck at home, and then our response rate has been pretty high. But the tax return deadline, so your 2019 income tax return is not due now until July 15th, 2020, which is a pretty long extension, and you don't have to do anything to get that extension. It's automatic. If you need additional time after that, you can apply for the traditional extension that you would have applied for on April 15th. And your return will be extended to October 15th if you need that additional time. But again, to get the July 15th deadline, you don't have to do anything. To get the October 15th deadline, you do have to take some affirmative action. I think more importantly, the tax payment deadline has been extended. So I know some people are feeling a cash crunch. April 15th can be a dreaded day for many. And now we've been able to push that out to July 15th. There is no interest or penalties on that extension. So if you take until July 15th to pay your 2019 income taxes, you do not incur any interest or penalty on that. Typically, you do incur interest and penalties if you don't pay timely. This extension includes any payments, including your first quarter 2020 estimated tax payment. If you pay estimated taxes, any payment that's due April 15th is now due July 15th. One nuance is that second quarter estimated tax payments still appear to be due on June 15th. So you do have to be mindful of that June 15th deadline. I've not seen anything that indicates that the June 15th second quarter estimate can be pushed out as well. So you may want to check with your tax preparer on that. But this includes individual tax forms, corporate tax forms, trust and estates tax forms, anything traditionally due April 15th. As I said, it doesn't include the second quarter 2020 estimated tax payments. And if you failed to make your 2019 estimated tax payments, you still will get that penalty. So just something to be aware of if you didn't make your prior year estimated tax payments. So that's on the federal side. Where this has gotten a little bit tricky is tracking all of the state responses because the state returns are not necessarily, the due dates in any event are not tied to the federal due dates. Virginia has taken the position that they will extend the payment of your income taxes. Typically, they are due May 1st. So your 2019 income taxes would have been due by May 1st, 2020. Virginia has extended the payment due date to June 1st, 2020. They do not extend the filing date, and nor do they waive any interest. So if you don't pay by May 1st, you will incur interest. Interest will start to accrue from May 1st until the date that you pay. Virginia's position on this is that they Virginia by constitution is required to have a balanced budget. And so if they do not have a balanced budget, the state cannot operate. So Virginia really is not in as much of a position to push out the tax payment any further than that month. And that is also why they are accruing interest, because Virginia really needs the cash to operate. I think that I'm going to transition back now to Tim for the next slide.
So there are some different strategies one might employ if you believe that we're in a recession and we'll be in a recovery in a few months. Generally speaking, the stock market is taking a big hit right now and should recover with the economy. This was the fastest correction and fastest bear market in the history of the New York Stock Exchange. So it has been a very new, extremely fast process. The recovery might be slower, but it could also start soon. So starting this summer, if we have a recovery and stock prices rebound before then or during summer, then this is an optimal time to have some estate planning and make some gifts to family. Also, anybody with an IRA, and it can be an IRA rollover from a 401k, anyone's eligible to convert that into a Roth IRA. Because of the sell-off in the financial markets, you can probably convert a larger percentage of your IRA to a Roth and pay the same amount of tax. So it is a taxable event, and if you're not taking an IRA RMD this year, maybe you have room for a taxable event. So you can move part or all of any traditional or IRA rollovers and convert those into a Roth. Roths have a lot of benefits. You never have to make a withdrawal. Your heirs would, but you and your spouse would not. And you just have continual tax-free compounding. And then when any money is taken out by you or your heirs, no tax is paid on it, federal or state. So it's a terrific vehicle. And it's certainly the best thing to inherit. But even if you just have a regular IRA and are entering retirement or thinking about it, it's still nice to have a Roth, because in a high tax year, if you need extra cash, you can take it out of the Roth and not incur higher taxes or a higher tax rate. So it's a nice planning vehicle. So
in addition,
again, yeah, go ahead.
Oh, sorry, Tim. I just wanted to add that you talked about you may be able to take the tax impact this year. The CARES Act also provides some additional charitable deduction benefits and increased limits on cash contributions to public charities. So if you do take a Roth, if you make a Roth conversion in 2020, you may, and have a higher adjusted gross income, you may actually get a bigger charitable deduction if you're so inclined. So it may be a good tax planning opportunity on the income tax side. If you're going to take the tax impact for the Roth conversion, you may be able to get a better charitable deduction this year as well.
So you can convert a balance now, pay tax on that balance, and then if we're correct about the stock market, we're at low levels and we'll be at higher levels in the near future, then that's an excellent time to lock in that conversion at when the market's low, and to have your Roth grow from that low point at a higher rate. So we do think there's a good possibility of a nice recovery over the next 2 years, and the next slide shows an example of that. So if we look back to the financial crisis, which was quite devastating, and we saw not only Bear Stearns and Lehman go under, but we saw Fannie Mae and Freddie Mac go under or go into receivership. Quite a disastrous financial crisis, and the market bottomed in March of 2009, and the news was still bad. So we hadn't exited the recession yet, but the Federal Reserve was taking the right actions. Quantitative easing one was in effect, and the federal government had started spending programs. Of course, right now, the federal government has already passed a spending program that's bigger than the two main programs of the financial crisis combined. And the Federal Reserve's buying power, it being unlimited with treasuries and mortgage-backed securities, and then also the Federal Reserve now buying risk-based assets because of the stimulus law. The QE effect of those purchases could be 9 or 10 times the effect of QE1. So with the possibility that we get some positive developments from drug companies and studies, clinical studies over the next month, and we pass the hump in cases and the deaths from this no longer accelerating but decelerating, people will be more apt to look forward, and the government will be more apt to allow businesses to reopen. And so you could have an economic recovery that starts in June or July of this year. And so if the stock market does move in advance of the economy, which is typical, you might see a bounce back. And in this case, in March of 2009, you see the bounce started. And certainly this week feels like a little bit of a bounce in the stock market. And then it continued to rise. So if you had bought in March of 2009, then by the time the news headlines were slightly positive on the economy 2 years later, you would have more than doubled your money. So you would have had over 100% return over the subsequent 2 years. Now, this was not a strong recovery by any means. And as always, there were negative headlines, but they were pretty bad headlines. So layoffs kept coming, unemployment rate kept rising, and mortgage defaults continued. This is not a mortgage-backed crisis that we're in now. It's more healthcare travel related, and I think we'll see a faster bounce back to the economy. And with all the stimulus that the federal government and the Federal Reserve is pushing into the system right now, it could be stronger, that recovery, than a lot of people expect. So what a great time to maneuver your portfolios right now. So whether you are doing a conversion or other estate tax planning, or you want to switch investment categories, or you've always been wanting to get out of a certain stock holding and put the money in other stocks, well, at these low levels, you'll pay less tax in doing so. So it's a great opportunity to make sure that your portfolio is invested the way that you would like it to be long-term, but also to position it for an economic recovery and a rebound in the stock market. So nothing's guaranteed, but we do think this is quite a likely outcome.
With that, thank you. We will be taking questions now. We've actually already received quite a few questions, and if you have a question, once again, please type it in. But we'll start off with the first question we received. Obviously, the CARES relief package has added significant amount to the deficit. Do you feel like this will really hinder children with dealing with this angst going forward? I'll give that to Tim.
So it is adding a great deal of debt. So it's accelerating that problem that we have. And it is a problem. And when the Federal Reserve stops buying bonds in 2 years, we should see one consequence of all this debt is that interest rates should be a little bit higher, especially on longer term debt. And So that's an additional cost for the federal government, and as they incur that interest, the deficit just grows that much faster. What you need to counter this deficit spending is most of the budget these days, outside of stimulus packages, is for so-called entitlements. So if the growth rate of entitlements could be somewhat restrained, which takes a lot of political will, that would help a lot. Also, if inflation helps tame accrued debt, and that in today's dollars, the accrued debt is not as much. The future accrued debt is not as much because it loses value each year. And the government says we've had 1% inflation, in recent years. Some of us who write the checks realize that inflation is a little bit higher than what the government's been stating. And then the third way to help fight this deficit is to grow the economy. So as the economy grows at a faster rate, the government will have more tax revenue. And in theory, some of that can go to not running deficits and possibly pay back some of the debt. So it is a problem. We are paying attention to it, and we do model in higher interest rates when we are looking at our companies. So both with bond investing and stock investing, we take that into account when we're looking at 3 to 5 years.
Great. Next question is another one for you, Tim. Is given the uncertainty in the market right now, what investment strategy should those in retirement or semi-retirement be looking at, given the uncertainty?
Well, on the equity or stock side, we can put together a portfolio of growth and income stocks, and a portfolio of dividend growth stocks that have average yields, dividend yields of 4 or 5%. And with most of the underlying companies raising those dividends annually, having a track record of doing so, and we buy many of the ones that we think will continue that track record. And so to have a growth portfolio, and a growth and income portfolio that's yielding 4 or 5% in an environment where the 10-year Treasury bond is yielding less than 1%, it's quite amazing. And I've certainly never seen that opportunity set before. So where you have a allocation range to stocks and an allocation range to bonds, this is a good time to reallocate and trim your bond holdings and move to the lower threshold of your asset allocation window for bonds, and put that money to work in stocks. But the dividend paying stocks and the companies that continue to grow and grow their dividends should be very attractive for somebody in retirement or approaching retirement right now. Generating all that cash income on an annual basis, regardless of whether the stock market goes up or down, provides a nice cushion. And historically, when you are in rough times, those stocks don't tend to fall as much as the overall market. So your history suggests you're not taking as much risk, but you are participating in the equity markets long term, which is important since there's long-term inflation, and you are making a very attractive cash dividend yield that can grow over time. So we certainly recommend that for retirees.
Great. Next question is for Molly. So for inherited IRAs where distribution has not been taken yet in 2020, can distribution be waived for this year for 2020 as well?
Yes, it can. Inherited IRAs are in the group where the 2020 required distribution has been waived. It also appears that inherited IRAs where there is no designated beneficiary, meaning it may pay to an estate or to a trust, and you're stuck with that 5-year rule for payout. It appears that even if you're stuck with that 5-year rule, you have a waiver for 2020. So you get an extra, get a little bit of an extra benefit there without having to take the distribution.
Great. Also, please, just as a reminder, you can type in your questions there into the box, and we'll address them all. Next question: does converting a traditional IRA to a Roth IRA strategy also apply to individuals who are not taking distributions from traditional IRAs? I'll pass that to Molly.
In terms of the conversion, can you repeat the question, Brad?
It says, does converting a traditional IRA to a Roth IRA strategy also apply to individuals who are not currently taking distributions from that traditional IRA? So I guess they're under the age.
Yeah, if you're under the age for your required distributions, yes, it does apply. So you can go ahead and make that conversion and use some of the strategies that Tim was talking about, really, to make that conversion. You'd pay the tax in the year of conversion, but again, with the CARES Act, if you are charitably inclined, you can get a benefit for that increased adjusted gross income that you have. So yes, this may be a good year to make that conversion with the assets in the traditional IRA being at a lower value.
So any IRA or IRA rollover can be converted into a Roth, or any part of an IRA or IRA rollover, and that can be done at any age. And there's the benefit of doing it when you're younger is that you have more years of tax deferred compounding, or tax exempt compounding of returns in a Roth. And compounding returns is the compounding of returns is an investor's best friend. So compounding at 3%, let's say inflation, that doubles every 20 years. Growing at 7% per year would double the portfolio value by every 10 years, and growing at 10% a year would double the portfolio value every 7 years. So if somebody has a long period of time until they retire or until they plan to use this money, then it's even more advantageous. And again, with that dividend strategy, it works rather well, because when you are forced to take money out of your traditional IRA or IRA rollover with the money that you have not moved to a Roth, a lot of those withdrawals can be funded with just the cash dividends. And so you don't have to touch much of the principal of your IRA when you're forced to make these withdrawals in future years.
With that, that looks like that is all the questions we have. So really appreciate everyone's time this morning. And we will have a replay of this webinar up on our website. And if it's all right, Molly, we'll pass out your email address when we send out some information here from the deck. So if you have any follow-up questions you wanted to ask directly to Tim or Molly, we'll pass along the email addresses.
Sounds great.
Thank you for joining us today.
Thank you,
Brad.
all very much. Thanks again, Brad.
Yep, absolutely. Thank you.